In this video, we're going to be taking a look at a simple to follow guide to secure passive income through investing in dividend stocks. I'll be teaching you what dividend investing is, how it can be used to secure passive income, and some simple to follow strategies to make this investing method as effective as possible. What's going on, everyone? Welcome back to the channel where I bring weekly investing and finance related advice. If you're new here, consider subscribing. All the support is greatly appreciated. I'll leave timestamps in the description box below, and links to everything that I mentioned in this video can also be found there as well. Investing in dividend stocks is one of the easiest and most consistent ways to gain passive income. So I'll teach you how you can quickly identify businesses that offer dividends as part of their investing structure. Remember, if you learn something new or gain value from the video, make sure to leave a like. So right now, I'll be sharing my guide on how to make this investing strategy as effective as possible. So just to get started, I'll explain what a dividend is. So essentially, a dividend is just a payback to investors from the company, which can be expressed either as a percentage of your investment or based on the number of shares that you own in the particular company. So I'll also jump into what is passive income. So passive income is a model of income where you do the work up front for something but don't receive any money, and then over time, for the work you've done initially, you'll start to receive payment for it. So with dividend investing, you'll put your money into a company and then you'll start to receive dividends from it, which you don't have to work for initially, but you've put in the time and saved the money to make the initial investment. So say for example, you had $1,000 invested in a company and it had a dividend payback of 3%, you would get $30 back in the form of a dividend. Now, dividends can be paid back typically on an annual or a quarterly basis. So essentially, once you put your money into that company, you can start receiving passive income from it in the form of the dividend payback that you'll receive. But there's a bit more to it than that, and there's more things to consider. So the first thing to consider is what kind of company you're putting your money into. So there's variability in terms of the amount of dividend you get back from a company. So for example, if you're getting a dividend payment from a company such as Apple, which is a 0.76% return, versus something like a Vanguard ETF, which can sit at around 1.4% to about 3%. So some of the key differences to keep in mind between the two examples that I've given is that Apple is an individual company, so therefore if you put your money in Apple for the dividend payout, you'll have to participate in all the ups and downs that that company will undergo. So you might still get your dividend, but if the company drops in value and say it goes down 10% over a year, but you still get your 0.78% payback from the dividend, you'll overall have lost money in the grand scheme of things. But if you invest in something like the Vanguard ETFs, which essentially just track the market, and therefore there's a bit more safety with this type of investment, because if, for example, one company in the ETF drops in value, other ones will be rising in value, and therefore they'll balance each other out to have a consistent growth over time. And as the price of the share grows, so will your investment, and you'll also be receiving dividend payments throughout this period of time. It's something to weigh up. Do you want to participate in a single company, or do you want to have your investment spread out amongst multiple businesses? There is more risk with the individual company, but as opposed to thinking of making profit through the dividend, you can make profit through the share price rising. Apple was priced at $100 a share, but then it gained 20% in a year. You'll have made 20% of profit, as opposed to the lower dividend yield of maybe 2 to 3% you might get with that ETF. It's something to keep in mind. If you invest in ETFs, it's a passive income or passive investing structure, a set and forget strategy, because you don't have to spend any time researching the company that you're putting your money into, and you can just leave it and let it grow over time and reap the rewards from the dividend payback and the growing share price. However, with an active investing approach where you put your money into individual companies, it can also be used to generate passive income, because as the share price grows, so will the value of your investment, and you'll be able to create a profit from the money that you've put in. But it takes time to understand the business and looking at technical factors that lead to understanding of a company, like looking at a 10K report, reading financial statements, listening to conference calls where management discusses different ideas for the business, can be a time-consuming process, so people often deviate towards a passive investing approach looking to gain money from a dividend. Active investing still falls under the passive income model because it's the idea that you put the time in and research the company and you don't gain any profit during this time. But after you've put in the work to understand the company and you've made the investment should grow over time, and then you'll start to receive passive income from the money that you've put in. Now, something important to address is that using dividend investing as a source of passive income is not a get-rich-quick scheme, and it's something that takes time to generate. If you only receive, say, a 2 to 3% return from the dividend and a slow grow in share price from the initial investment, it's not really something that's going to make you rich overnight, and it's really just a way to make your money work for you as opposed to having it sit in the bank where the interest rate can be quite minimal. It can just be an effective tool to make a bit more money from your savings. Well, that wraps it up for the video. I hope you found the content useful and you're feeling a bit more confident with how you can use a dividend investing to generate passive income. Remember, if you want to support the channel, subscribe and feel free to click the links on screen, and I'll see you guys in the next video. Thanks for watching.